Imagine for a moment that you wake up tomorrow and discover that while you were sleeping, the value of your money has been redefined, not by a decision you made, but by one that others made for you. It happens more frequently than you think, and it happens silently. Governments don't announce that they're going to weaken your currency. Central banks don't publish statements saying they're going to compress your purchasing power. It simply happens, and when it does, most people find themselves completely unprepared with no real shelter to turn to. But there is something that always remains, something that has remained for millennia, passing through empire after empire, crisis after crisis, system after system. Gold, not gold as a speculative bet, not as a symbol of status, but as that which represents what your money should be but no longer is. A real promise, an asset that cannot be printed at will, that does not depend on faith in institutions, that exists beyond the reach of any monetary policy. Now, within the world of gold, there are distinctions that most investors never learn about until it's too late. Not all forms of gold are treated the same way when the rules of the game change. And the rules are changing. If this type of analysis helps you see the market from a different perspective and understand how to protect your wealth, I invite you to subscribe to the channel now. We don't want you to miss the next reports and alerts we'll be sharing as this economic cycle we're living in unfolds. What I'm going to reveal to you today is a result of studying patterns that repeat lessons that history has taught us again and again, and an understanding of how systems really work when they're under pressure. Specifically, we're going to explore 5 gold coins that you should consider securing in your collection now, before the next market changes make it significantly more difficult to access them or much more costly to do so. To understand why these particular coins matter, we first need to understand something fundamental about how governments have acted historically when facing monetary crises. In 1933, when the world was in the heart of the Great Depression and governments were beginning to lose control over their financial systems, the United States made a decision that most people didn't see coming. The executive branch, under Presidential Executive Order 6102, forced American citizens to surrender nearly all their gold to the Federal Reserve in exchange for paper money. It was presented as a patriotic act, as something necessary to save the country. But when you look at the details, you see something fascinating that changed everything. Not all forms of gold were included in that requirement. The coins that were classified as rare or of numismatic value, those with historical or collectible characteristics, were specifically exempted from the order. This means that while most citizens lost their gold, those who possessed certain specific types of coins were able to keep it legally. When the government later raised the price of gold from $20.67 per ounce to $35 per ounce, citizens who had been forced to surrender their gold at the previous rate lost significantly. But those who owned gold eagles and maintained them legally saw the value of their coins increase proportionally. Not only because the price of gold went up, but also because the supply of gold in private hands had been drastically reduced, making the eagles even more valuable. This is the lesson that resonates through the years. In any monetary crisis, there are winners and losers, and the difference between them often depends on understanding how laws classify and treat assets.
Remember that this content is educational and does not constitute financial advice. Its purpose is to help you think more clearly about how to protect your financial decisions.
Let me now turn to the 5 coins you should consider, beginning with the first, the U.S. Gold Eagle from before 1933. These coins were minted between 1907 and 1933, and they represent something unique in the market. They were produced as legal tender, which means they had an official monetary purpose. The government created them deliberately to function as money. This is distinct from many other gold coins that were minted primarily as collectible objects or as tools for accumulating value. The eagles were minted with the clear intention of being used in everyday transactions, in commerce, in the daily economic life of the nation. But here's the crucial part. Although they were minted during that specific period, they were later classified by U.S. legislation as coins of numismatic value. This means that although they are pure gold, although they have the same metal content as contemporary gold coins, they receive different legal treatment. When Executive Order 6102 was enacted in 1933, it specifically exempted U.S. coins of recognized numismatic value. The eagles were considered within that category. The government's reasoning was that these coins were so historically significant, so internationally recognized, that reclassifying them as bullion would be politically untenable. Furthermore, numismatic scholars had already devoted substantial resources to cataloging and valuing these coins. Reclassifying them would have violated that established academic work. The legal precedent was already cemented. What happened afterward is instructive. When the government later raised the price of gold from $20.67 per ounce to $35 per ounce, citizens who had been forced to surrender their gold in exchange for paper money at the previous rate lost significantly. But those who possessed gold eagles and maintained them legally saw the value of their coins increase proportionally, not only because the gold price rose, but also because the supply of gold in private hands had been drastically reduced, making the eagles even more valuable. If this sounds like a lesson from nearly a century ago that has no relevance today, consider this. The same laws that exempted the eagles remain in American law books. The classification of these coins as numismatic remains legal. If tomorrow the government decided to reclassify certain types of gold, there would be a clear legal line already established along which to do so. The pre-1933 eagles would be on the safe side of that line. The market understands this perfectly. These coins regularly sell with a significant premium above the value of the contained gold. If you had a 1,920 gold eagle with nearly 1 ounce of pure gold content, and gold sells for $2,000 per ounce, you might assume that coin is worth about $2,000. But in reality, those coins regularly sell for $2,400, $2,500, even $3,000 or more. That premium isn't arbitrary. It's the market assigning value to the legal protection they represent. It's investors worldwide saying that they understand the historical lesson. They understand that legal classification matters. They understand that there's value in owning something that has been specifically protected by law, but there's more. Pre-1933. Gold eagles also have something that makes them particularly valuable in the current context. They're recognized internationally, not just in the United States, but worldwide. Collectors from the Middle East, from Europe, from Asia, all know what a U.S. gold eagle is. They understand its value. They know how to evaluate it. This means that if you ever needed to sell one of these coins, you'd have access to a genuinely global market. You're not limited to finding a buyer in your country. You can sell to anyone, anywhere in the world who has the resources. In a world where governments can freeze assets, where they can do things with digital money that would be unthinkable with physical gold, having access to truly global markets is a form of insurance. It's a way of saying that your value isn't under the control of a single jurisdiction. If something happened in your country that made it dangerous to hold wealth there, you could access international markets. You could liquidate your position. You could move to different jurisdictions. Gold eagles give you that ability. The second coin that should be in your consideration is the British gold pound sterling, specifically the version prior to 1933. The reason these coins matter is different from the U.S. gold eagles, although the underlying principles are similar. The United Kingdom has a long and complicated history with gold, and that history runs much deeper than that of the United States. It was the United Kingdom that invented the formal gold standard. For centuries, while other nations experimented with paper money, devaluations, and chaotic monetary systems, the UK maintained a disciplined connection to gold. The British pound was literally backed by gold. It wasn't a promise of money, it was money. When the British minted a gold pound sterling, they were minting what was effectively a world currency. The British pound was the world's reserve currency for over a century. All international commerce passed through the pound. Governments held it. Banks accumulated it. Merchants accepted it without hesitation from any part of the world. A gold pound sterling minted in 1890 was just as valid in Hong Kong as it was in London. What this means is that pre-1933 gold pound sterling coins, especially those from the Victorian and Edwardian eras, represent more than just gold. They represent an era of genuine monetary confidence. They represent a period when a currency was so universally respected that it could be used in transactions anywhere in the world without anyone questioning its value. That's rare. In monetary history, there are very few currencies that achieved that level of universal acceptance. When you own a gold pound sterling from that era, you own a fragment of that historical prestige. You own something that was once the closest thing to a world currency that has ever existed. And that pedigree doesn't disappear. Governments understand that. Legislators understand that. Experts understand that. If there ever is a reclassification of what gold is permitted in private hands, it would be extraordinarily difficult to reclassify the gold pound sterling as something that should be surrendered. History gets in the way. International prestige gets in the way. The shared understanding that this coin is special gets in the way. Furthermore, you need to understand that the United Kingdom never confiscated gold from its citizens the way the United States did. When the UK suspended the gold standard in 1931, it didn't order citizens to surrender their coins. It was more subtle. It was a policy change. The gold pound sterlings that people possess simply stopped being backed by the government's promise to exchange them for gold at a fixed price. But people could keep them. They could store them. They could sell them. This gentler treatment reflects something about British political culture, something that persists to this day. There's a greater reluctance to confiscate personal assets in an explicit and open way. What's interesting about gold pound sterlings is that in modern Britain, these coins have a special legal status. They're considered antique coins. They're treated differently in terms of taxes, regulations, how they can be bought and sold. There's established jurisprudence around them. There's clarity surrounding their legal classification. This matters because it means that if someone wanted to reclassify these coins, they'd have to navigate an existing body of law and precedent. It would be a major change. It would be visible. It would be politically questionable. When you analyze gold pound sterlings, especially those from the Victorian era, you see that they were minted in quantities that reflected the demand of the time. They weren't minted massively as speculation. They were minted as money to be used in commerce. That means there's a limited quantity of them in circulation. They're not rare, like a rare collectible coin, but they're not abundant either. They're in the sweet spot. There's enough to be accessible. There's not enough to be trivial. The market for them is deep, but not infinitely liquid. It's exactly what you want in a coin you plan to maintain as a long-term store of value. Now, consider an additional aspect. The United Kingdom is outside the Eurozone. The euro is the currency of most of Europe, but not the UK. This means that if there's a crisis affecting the euro, if there's a reclassification of how European currency is treated, Gold pound sterlings aren't directly affected. They're a separate exposure. They're a way to diversify your currency risk. If you have all your gold in Eurozone coins, you're making a bet on euro stability. If you have part of your gold in gold pound sterlings, you're diversifying that bet. Now we come to the third coin on our list, the Swiss gold franc. Switzerland presents a particularly interesting case in world monetary history, and it's a case that tends to be widely misunderstood. Unlike many other nations, Switzerland has consistently stayed outside the most severe monetary crises. This wasn't an accident. It wasn't luck. It was the result of deliberate and disciplined decisions about how to manage monetary assets and fiscal policy. During World War II, while the rest of Europe was falling apart, Switzerland maintained stability. It wasn't because they didn't face pressure. It was because their institutions were strong enough to resist that pressure. It was because there was political consensus around the need for stability. Switzerland maintained a stronger connection to gold for longer than almost any other nation. Even after other countries abandoned the gold standard, even after the Federal Reserve stopped backing the dollar with gold, Switzerland remained disciplined. The Swiss franc remained relatively stable. Switzerland continued accumulating gold. Switzerland continued making decisions that prioritized long-term monetary stability over short-term political impulses. The gold coins of Switzerland from the early 20th century, especially the Swiss gold franc, reflect that credibility. They represent a currency issued by a nation that has never been militarily occupied in modern times. Switzerland was occupied in the distant past, but not in the last 3 or 4 centuries. It represents a nation that never confiscated gold from its citizens. It represents a nation that never used currency as an instrument of financial repression. It represents a nation that has demonstrated over centuries that governments can be trustworthy if they choose to be. When you own a Swiss gold franc, you own more than just gold. You own the history of a monetary institution that has demonstrated the ability to protect value for over 2 centuries. You own a currency issued by a nation whose constitution, whose laws, whose political culture is built around the idea that money must be honored, it must be stable, it must maintain its value. Now, an additional point about Switzerland that's crucial. Switzerland remains outside the European Union. This is a deliberate political choice. The Swiss have rejected EU membership, maintaining their monetary and fiscal independence. It remains outside the euro. It remains outside many of the regulations that govern Europe. This is important because it means that if there's a crisis affecting the European Union, if there's a reclassification of European currencies, if there's a redefinition of what constitutes money in Europe, Swiss historical coins maintain their separate identity. They're not trapped within the European system. They're not subject to decisions from Brussels or the European Central Bank. This places them in a particularly advantageous position. If you fear something might happen in Europe, if the EU might make decisions that harm you, owning Swiss gold francs is a way to diversify that risk outside the European system while remaining in a developed, stable, internationally respected currency. It's like having a life raft if the European ship begins to sink. Furthermore, the international market deeply respects Switzerland and its coins. Bankers worldwide understand the quality of Swiss institutions. They'll understand the value of a Swiss gold franc. They'll know how to evaluate it. They'll know how to buy and sell it. You won't need to search in the dark to find a buyer. The market exists. It's global. It's deep. Let's now consider the fourth coin on our list, the Canadian gold maple leaf coin from before 1986. This might seem recent compared to the others, but here's what's crucial. In 1986, Canada changed the legal composition of how it defines its gold coins. The maple leaves prior to that date were minted under a different legal regime. They were designed and regulated as legal tender, without the complexities that came later. When Canada minted gold coins pre-1986, it did so with a clear purpose: to create money, currency that could circulate, money that had value, stability. What makes the pre-1986 maple leaves particularly valuable is that Canada, as a nation, has a peculiar and clear relationship with gold. Gold is a strategic Canadian commodity. Canada is one of the world's leading gold producers. Gold is part of the nation's economic identity. It's part of its history. It's part of how Canadians understand their place in the world. The coins minted in the period before the late 1982 reforms have a purity of classification and monetary purpose that's unequivocal. They weren't created primarily as investments. They were created as money. That's distinct. When the Canadian government mints gold coins before 1986, there's a clear legal document that says why. There are established regulations. There's historical context. Changing all that retroactively would be legally and politically violent. Changing that would mean admitting that Canada made a mistake in 1986 when it decided to alter the regulations. Governments rarely want to do that. It's easier to simply leave things as they are. Furthermore, after 1986, when Canada modified the regulations, the market responded. People saw that the classification of the maple leaves had changed. They began seeking coins from before 1986. They began rewarding those coins with higher prices. The market instituted a distinction. Now there's a clear difference between pre-1986 maple leaves and post-1986 ones. The earlier ones trade higher, they're valued differently, they're treated as something special. This is important because it means that if governments ever decide to redefine what constitutes monetary gold versus gold permitted in private hands, there's already an established precedent for how to make that distinction. The market is already making the distinction. People already expect it to be made. It's much more likely that such reclassification, if it happens, will respect the pre-1986 versus post-1986 distinction. Furthermore, Canada has notable political stability. It has solid institutions. It doesn't have a history of violent government changes or erratic monetary policies. If you needed to trust that a government would keep its word about coin classifications, Canada is a reasonable place to do so. It's not without risk, but it's lower risk than many other nations. Now let's consider the fifth and final coin, the Dutch gold gulden, specifically the 10 gulden version, minted between 1875 and 1933. The Netherlands has a fascinating history with gold and monetary stability that's deeply connected to its identity as a nation. For centuries, it was a financial power. The Dutch invented or perfected many of the modern financial systems we still use today. Dutch commerce was world commerce for centuries. Dutch capital financed empires. When you study the history of global trade, you constantly find references to Dutch bankers, Dutch merchants, Dutch ability to mobilize capital on an international scale. The Dutch florin was one of the first currencies to achieve the status of an international reserve currency. It was used in trade across oceans. It was accumulated by governments. It was trustworthy. The gold guldens minted in the period between 1875 and 1933 represent that era of monetary credibility. What makes the Dutch gold gulden special is that it represents gold minted during a period when the Netherlands maintained an extraordinarily stable monetary system. Unlike many other nations, the Netherlands didn't experience the same monetary chaos. It was an act of political intelligence and financial prudence. While other countries were experiencing banking crises, while other governments were devaluing their currencies, while other monetary systems were collapsing, the Netherlands maintained course. The coins from that period reflect that stability. When you own a Dutch gold gulden from 1880, you own a coin that was minted during an era when the Netherlands was deliberately conservative with its money, deliberately disciplined, deliberately focused on maintaining value. That's something special. It's rare. Furthermore, the Netherlands is located in the heart of Europe but maintained a separate monetary identity from many other European countries during the relevant period. When most of Europe was experiencing monetary crises, the Netherlands remained relatively steady. This reflects the ability of Dutch institutions to make intelligent decisions about money even when facing external pressure. Now, an additional aspect of the Dutch gold gulden that's important, these coins have deep international recognition. They're known among coin collectors worldwide. They're cataloged. They're studied. There's academic literature about them. There are experts who understand their value. This means you have access to a genuinely global market for these coins. It's not an obscure market. It's not something that's difficult to understand. It's an established market with established prices, with buyers and sellers in multiple countries. Now, some might argue that I've chosen coins from developed nations, from nations with strong institutions. And they're right. I've done that deliberately. The reason is that legal classification, legal protection matters more when you're in a nation with a legal system that actually works. If you live in a country where rule of law is weak, where governments routinely ignore the law, then no amount of legal classification will protect you. But if you live in a country with strong institutions, with a functioning legal system, then legal classification matters enormously. The 5 nations I've selected, the United States, United Kingdom, Switzerland, Canada, and the Netherlands, all have legal systems that work. They all have traditions of respect for the law. They all have governments that, though imperfect, generally respect the rule of law. That's why their historical coins are especially valuable. That's why they have special protections. That's why they have more secure futures if monetary policy changes. Let me delve deeper into something I mentioned briefly, but that's crucial. The question of why governments would make distinctions between different forms of gold if they sought to confiscate it. The answer is that governments don't necessarily want to confiscate everything. They want money. They want assets. But confiscating everything is politically complicated. It generates resistance. It generates discontent. It generates fear of government. That's why intelligent governments create exceptions. They create categories. They say that certain types of gold can be maintained because they're collectible, or because they're historically significant, or because they're so rare that they're not worth confiscating. This is a way of making confiscation less unpopular. It's a way of saying that there's a legal side to confiscation, a side that respects certain forms of property. When you do this, you reduce political resistance. People are less likely to rebel if they see there are exceptions. If they see that certain types of property are being protected, even if they're losing other things, they see that not everything is being taken. This is political psychology. It's how governments do difficult things without creating riots. So if there's ever a redefinition of what gold is permitted in private hands, there will very likely be exceptions. It's very likely that certain types of coins will be protected. And it's very likely that those coins will be exactly the ones I've discussed today, the historically significant ones, the ones that already have legal precedent, the ones that are already treated as something special. Let me give you a practical example of how this might work. Imagine that within the next 5 years, governments face unsustainable fiscal pressures. Imagine they decide they need access to more monetary assets. Imagine they redefine what monetary gold is in their regulatory code. They might say something like this: all modern gold bullion must be reported and, if necessary, contributed to the government in exchange for compensation determined by the state. However, coins minted before 1933, coins of recognized numismatic value, and coins historically significant and classified as rare shall be exempt from this requirement. Under that redefinition, the pre-1933 gold eagle would be protected, the Swiss gold franc would be protected, the gold pound sterling would be protected, but the modern bullion you purchased last year from a precious metals dealer wouldn't be protected. It would be reclassified as government money, not your private property. Is this speculation? Yes. Could it happen? Possibly. Has it happened before? Exactly. In 1933, it happened precisely like this. Exceptions were written into law, distinctions were made, and those who possessed the correct side of the distinction benefited. Remember that the difference between being prepared and being surprised in these monetary matters is the difference between preserving your wealth and losing it. It's the difference between options and desperation. Now let's turn to why the timing is critical. We're living in an era of unprecedented monetary pressure. Central banks are creating money at speeds they haven't seen in decades. It's not a metaphor. It's literal. The amount of money in the system has increased exponentially. Governments are borrowing at levels that would have been unthinkable a generation ago. When you look at the numbers, they're simply unsustainable. U.S. federal debt is above $33 trillion. The debts of other Western governments are proportionally equivalent. Real interest rates are negative. This means that if you have cash in the bank or savings account, you're earning nominal interest but losing purchasing power in real terms. Inflation is greater than the interest rate you're earning. Each day that passes, your money becomes less valuable. This is a feature of a system under extreme stress. In a healthy system, real interest rates are positive. You earn money by keeping it safe. But in a system under stress, central banks reduce real interest rates to negative as a way of favoring borrowers over savers. It's a redistribution of wealth from savers to governments and corporations that are indebted. In this environment, people begin seeking shelter. They begin seeking something real. They begin seeking something that can't be devalued by a central bank's decision. They begin seeking gold. When that happens, demand for gold increases. But here's where most people make a crucial error. They assume all gold is the same. They assume that if they buy gold, they're safe. But the truth is more complex. Gold is gold in terms of the pure metal. But gold isn't the same in terms of legal status, in terms of international recognition, in terms of the legal precedent surrounding it. The 5 coins I've discussed have something that protects them that many other forms of gold don't have. There's already established jurisprudence around their status. They're collectible. They're historical. They're internationally recognized as having value beyond their pure metal content. This places them in a different legal category. And in moments of pressure, those legal distinctions can be the difference between preserving your wealth and losing it. But there's more to this than just legal considerations. These coins have liquidity. The market for them is deep. There are buyers worldwide. This matters because in moments of crisis, illiquid assets become problematic. You can't convert them to cash quickly. But these coins have had established markets for more than a century. There are specialized auction houses, there are organized collectors, there are professional dealers. The infrastructure to convert these coins to money exists and has proven resilient through multiple economic cycles. Even during the Great Depression, even during World War II, even during the financial collapses of the 20th century, a market for these coins existed. Let me talk more deeply about geographic diversification, a concept that many investors don't fully understand. If all your wealth is concentrated in a single country, you're vulnerable to that government's decisions. If your country's government decides to confiscate gold, restricts your ability to leave the country, or simply inflates the currency massively, your wealth is affected. But if you have part of your wealth in forms that are recognized internationally, that have markets in multiple countries, that don't depend on your home country's institutions, then you have options. Part of the reason the Swiss franc, the gold pound sterling, and the Dutch golden matter in a gold portfolio is that they represent exposure to different jurisdictions. If there's ever a crisis that deeply affects your home country, you have assets that are positioned differently. If there's a crisis in the Eurozone, the Swiss franc isn't directly affected. If there's a crisis in the UK, the Swiss franc is still a Swiss asset. If there's a crisis in North America, you have exposure to different European governments. This is important because no government is perfectly stable. No monetary system is secure forever. History demonstrates that systems change, governments fall, currencies collapse. Systems that seemed permanent evaporate overnight. Geographic diversification is a way of acknowledging that reality. It's a way of saying that you expect your government to be responsible, but you also have a plan B if it isn't so. Now let's move to practical aspects. How should you proceed if you decide these coins make sense for your situation? First, establish for yourself what you can afford. This is critical. You don't need to massively purchase rare coins. You don't need to mortgage your house to own historical gold. Consider these coins as part of a broader diversification strategy. You could have a small position in each of these five, or you could concentrate on two or three. What matters is that they're real, that you physically own them, that you store them safely, and that you understand what you own. Second, educate yourself about provenance. This is critical. Authenticity matters. When you're buying these coins, work with established dealers who have a reputation. Counterfeits exist, scammers exist, but there are reliable methods to verify authenticity. You can get a coin certified by a professional grading company like PCGS or NGC. These companies employ experts who deeply understand numismatics. They examine coins under ultraviolet light. They measure weights. They analyze composition. They verify serial numbers. If a coin is certified by PCGS or NGC, you can be reasonably confident it's authentic. Third, understand that these aren't short-term investments. You're not buying these coins hoping the gold price rises tomorrow and then selling for a quick profit. That's speculation. You're buying these coins as insurance, as a long-duration position that gives you options if the monetary environment becomes difficult. You might own these coins for 10 years or 20 years or more before needing them. The point isn't to make a quick profit. The point is to preserve your purchasing power, is to protect yourself against adverse monetary scenarios, is to have a plan B if everything else fails. Fourth, seriously consider geographic diversification. If all your gold wealth is concentrated in U.S. gold coins, you're vulnerable to U.S. government decisions. If all your gold wealth is concentrated in Swiss coins, you're vulnerable to Swiss government decisions. But if you have some in gold eagles, some in gold pound sterlings, some in Swiss francs, some in Canadian maple leaves, and some in Dutch goldens, then you're not vulnerable to any single government. You've diversified the risk. Fifth, communicate with professionals if appropriate. an insurance advisor, a lawyer familiar with asset law, an accountant who understands tax implications. Different jurisdictions have different rules about gold possession, reporting, taxes, inheritance. In some countries, owning gold is relatively tax-free. In others, there are capital gains taxes when you sell. In others, there are taxes on possession itself. You don't want to discover these things when it's too late. It's better to know now while you still have time to plan. Now, some will say all of this is speculative, that it's paranoia, that it's pessimism, that it's thinking the worst about governments and systems. Maybe they're right, but consider the alternatives. Consider what happens if you don't prepare and something goes wrong. If there's suddenly a redefinition of what gold is permitted, if there are suddenly restrictions, if the government suddenly decides it needs your monetary assets, what do you do? What are your options? If you've been preparing, you have options. You have gold in a form that's already legally protected. You have assets that are geographically diversified. You have a plan. But if you haven't been preparing, you have no options. You're at the mercy of what happens. So the question is simple. Is the cost of preparation worth it? For most people, the answer is yes. The cost of owning a small percentage of your wealth in historical gold coins is relatively low. You could add the equivalent of a few $100s monthly to your gold portfolio and, over the course of a few years, build a significant position. That cost is low compared to the potential benefit if something goes wrong. Now let's address something many investors avoid, the question of custody. Owning physical gold means you have to store it somewhere. You can't just leave $2,000 in gold on your nightstand hoping nobody steals it. You need a secure place. There are several options. You can have a safe deposit box at a bank. You can have a safe in your home. You can use a company specializing in precious metals storage. Each option has advantages and disadvantages. A safe deposit box at a bank is secure. It's insured. It's less likely to be stolen. But if there's a government crisis, if the government decides it needs the contents of banks, it's accessible to them. Additionally, if something happens to the bank, your gold could be at risk. Bank safe deposit boxes aren't as secure as people think. A home safe is more private. Nobody knows it's there except you. If there's a redefinition of what gold is permitted, it's harder for the government to discover you have it, but it's more vulnerable to theft. If someone discovers you have gold in your house, they might try to steal it. Furthermore, home safes aren't truly secure. Most can be forced open if someone tries hard enough. Specialized precious metals storage companies are a middle ground. They specialize in precious metals security. They have military-grade vaults. They have insurance. They have experts. But you don't have physical possession of the gold. Depends on the company. If the company fails or is compromised, your gold could be at risk. The best strategy, in my opinion, is a combination. You have a small amount of gold in a safe in your home. This is your emergency amount. It's the gold you could access quickly if necessary. You have a larger amount in a specialized storage company. This is your long-term storage gold. It's what you're planning to keep for years or decades. And you might have a small amount in a bank safe deposit box, just for diversification. This strategy gives you options. If there's a redefinition of what gold is permitted, you have access to the amount in your home without the government knowing about it. If you need to sell something quickly, you have access to the amount in the specialized storage company. You're diversified. Now, let's return to the central question. Why these 5 coins specifically? I've explained the individual details of each one, but let me recap the common themes that make them special. First, They were all minted during periods when they were official money. They weren't minted primarily as speculation or as collectible objects. They were minted as money. That's important because it means there's a clear and legal purpose behind them. Second, they were all produced by nations with established monetary institutions and credibility. They're not coins from small or weak nations. They're coins from world powers. That matters because it means there are real institutions behind them. There's history. There's credibility. Third, they've all been extensively studied by legislators and legal systems. When Executive Order 6102 was issued in 1933, the U.S. government did so because it knew certain coins were special. There was already jurisprudence about them. Experts had already classified them as collectible. The government simply recognized the distinction that already existed. Fourth, they've all already been classified as exceptional under past or present confiscation laws. It's not as if I'm inventing this. It's not as if I'm speculating about which coins might be protected. The coins we've discussed already have established legal protections. They've already been considered by governments. They've already been allowed while other gold was confiscated. Fifth, they all have established global markets. You can sell any of these coins anywhere in the world. There are buyers. There are established prices. You have options. Sixth, they all have a reputation status dating back more than a century. They're not new. They're not obscure. They're coins that have been respected for generations. That respect will likely persist. Seventh, they all represent exposure to different countries. You have gold eagles from the United States. You have pound sterlings from Britain. You have Swiss francs from Switzerland. You have maple leafs from Canada. You have Dutch guldens from the Netherlands. You're geographically diversified. You're not betting that a single government or single monetary system will remain stable. Now, some might ask, why don't you include coins from other countries? Why not the Australian gold coin? Why not the South African gold coin? Why not the Russian gold ruble? Good question. The answer is that there's a spectrum of risk. The coins I've selected are on the low end of the risk spectrum. They're from nations with strong institutions, functioning legal systems, a long history of stability. Other countries might have interesting coins, but they come with more risk. They have less established institutions. They have less solid track records. They have less deep markets. If you're trying to protect yourself against extreme monetary crises, it's better to be with coins from countries with strong institutions. But that said, if you have a particular affinity for a country, if you believe it's especially stable, if you have connections to that place, then a gold coin from that country might make sense as part of your portfolio. What's important is understanding the underlying principles. You want coins that are historically significant. You want coins that have already been classified as collectible. You want coins from nations with strong institutions. You want geographic diversification. You want global markets. If you satisfy those criteria, you have a solid gold portfolio. Now, let me talk about something particularly relevant at the current moment. Central bank activity. Central banks worldwide, especially those from developing countries like China, India, Russia, and others, have been buying gold at an accelerating pace. Why are they doing that? If fiat money is as reliable as governments tell us, why are central banks accumulating gold? The answer is that they're preparing. They're recognizing that confidence in current monetary systems is eroding. They're recognizing that the future is uncertain. They're recognizing that gold is money. It's the only thing that has functioned as money throughout all of human history. It's what remains when everything else fails. If central banks are buying gold, then you should be buying too. If the world's most sophisticated money managers believe gold is important, then it probably is. You're not being paranoid, you're being prudent, you're following smart money. Now, some would say I'm exaggerating, that central banks are buying gold for technical reasons, that it's not a sign that the system is under stress. Maybe, but I'd say that central banks don't do things without reason, especially when those things require spending real capital, especially when those things are consistent across multiple independent central banks in multiple countries. When you see that level of consensus, when you see the world's most sophisticated money managers doing the same thing, then there's likely something real behind it. Let's now address a psychological aspect that's rarely discussed: how real assets feel versus digital assets. When you own a physical gold coin, you can touch it, you can hold it, you can see it shine, you can watch it age, you can feel its weight. There's something fundamentally different about owning a coin you can hold versus owning an entry in a database that says you own gold. One is real, the other is a promise. In moments of crisis, that difference becomes crucial. If there's a banking panic, if there's a financial system collapse, if there's an event that destroys confidence in digital systems, then the physical gold you own is real. It's yours. You can use it. But the gold you own on paper, the gold that exists only as a computer database entry, could simply disappear. The database could be erased. The server could fail. The intermediary could go bankrupt. I've seen this happen. I've seen financial institutions fail. I've seen people lose access to their digital assets. I've seen systems collapse. It's not paranoia. It's history. It's happened many times. It will happen again. When you own physical gold in coins that already have established legal protections, you have something that can't disappear in a software panic. You have something tangible. It's a different way of thinking about wealth. It's an older way. It's a way that's worked for millennia. Finally, let me be clear about what I'm saying and what I'm not saying. I'm saying that the current world monetary system is under significant stress. I'm saying that governments, when facing pressure, can make decisions that affect your wealth. I'm saying that it's prudent to have a plan. I'm saying that the 5 gold coins I've discussed offer a way to have a plan that's already backed by legal precedent. I'm not saying the world is going to collapse. I'm not saying that fiat money will be completely abandoned. I'm not saying that gold is going to reach $10,000 per ounce. I'm not saying you need to sell your house and convert it to gold. What I'm saying is that prudence requires preparation. It requires diversification. It requires options. And the 5 gold coins I've discussed are an elegant, established way to achieve that. In conclusion, let me leave you with this. We're living in a world of accelerating change. Systems we thought were permanent are being questioned. Authorities we thought were trustworthy are being reevaluated. Assets we thought were safe are showing extreme volatility. In that world, prudence requires diversification. It requires options. It requires assets that work when others fail. Gold, in the form of these 5 historical coins, is exactly that. It's not a panacea. It's not the solution to all your problems, but it's an intelligent part of a wealth preservation strategy. It's a way of saying that you understand historical patterns, that you understand that governments don't always act in your favor, that you recognize that options have value, that you recognize that the future is uncertain and that it's better to be prepared. Those who prepare early make calm and reflective choices. Those who wait until it's urgent make desperate choices. Desperate choices rarely end well. So if you understand the patterns I've described, if you recognize that something is changing in the world monetary system, If you recognize that governments can change the rules, then maybe it's time for you to make your own decision, not the one I recommend. The one you decide is right based on your situation, your risk tolerance, your vision of the future, and your understanding of history. But ask yourself a simple question. Am I prepared for what comes? Do I have options? Do I have assets that work if things change? If the answer is no, then maybe it's time to start thinking about it. Because the time to prepare is when it's calm. The time to act is before everyone else wants the same thing. That time is now. And if you understand that, if you act with clarity and conviction, then you've taken the first important step toward a position of true financial strength.